All right, now let's look at accounting for notes receivable and interest revenue. What's a note receivable? Remember, it's short for promissory note, old language. This means a promise to pay, and it's recognized on a note or piece of paper. It's a legal document, kind of like a check, but with more terms and wording on it, but the same kind of idea. Their assets, we record them either current or non-current. If it's more than a year, it'll be a long-term asset, that kind of thing. And then you could adjust it if it's going to be due in that period. You could adjust it from a long-term asset to a current asset. Some particular terms, you'll probably see these in business law down the road. Face value, the amount um, lent or borrowed. Due date, payee, that's who's getting paid, the maker, or payor is a person doing the paying, interest rate, the amount written out there. So let's look at an example here. So Kimsey provides $10,000 of services to Justin Payne, Justin Payne, who can't pay immediately, so it's account receivable. Well, then it became apparent that he couldn't pay, so they converted a account receivable to a note receivable with the terms we are just looking at, 6 months, 12%, due August 1st. So that transaction creates the note receivable and eliminates the account receivable, really just swapping one for the other, no net effect on the balance sheet because they're both assets. Key point, receivable to accounts receivable or similar to accounts receivable, except it's more formal, a written debt instrument or note. And that note could be sold to somebody else or used as collateral or various things like that, but it's more formal. Okay, so calculating the interest, and we've been doing this, that will utility or your calculator or something. So take the face value times interest rate, gives you the interest for the year, and then how many months is that interest being accrued for, gives you the total interest amount. Calculate interest at the face value times interest rate, appropriate fraction. There you go. So the collection of that, when we get that, it's cash. They're paying us cash. And it's two parts. And we've been talking about this a little bit. And here it is. So the note receivable and then the interest revenue. And whoops, those numbers don't equal. It should be 600 there. There's a typo there. Getting that cash, note receivable, and interest receivable. We also need an adjusting entry, and we've been doing these adjusting entries, haven't we? So at the end of the year, we want to, based on that accrual method, remember, recognize how much interest have we earned. So we would do that same interest calculation, but just for 2 months to recognize the 2 months of interest earned. And then for that revenue and then interest receivable is that asset, right? Creating through that adjusted entry. And then the rest of the term in the following period, we'll actually earn the other interest revenue in the future. So we'll see what that looks like. Okay, yeah, so the adjusting entry here is interest receivable, 200, and that interest revenue of 200, like we were just saying. That's the adjusting entry. And then when we collect all this, it is this, this should be August 1st. Boy, several typos here in the slide, sorry. Cash 10,600, note receivable is that original amount, 10,000. Interest receivable from the prior period, 200, and the interest revenue in the current period of 400, totaling 10,600. So a key point here, record the interest earned in the appropriate period as interest receivable and interest income, again, to keep it in accordance with the accrual basis. Good job.